Let's just face it, taxes in Canada are high, and they always feel like they're creeping up. Now, sure, you can claim a few small tax credits here and there, but that's not going to move the needle on your wealth building journey. So today, we're diving into 3 powerful and completely legal strategies that can actually change your financial future. Let's get into it. So, here's the game plan. First, we'll talk about the high tax problem and why so many Canadians feel stuck. Then, we'll break down our 3 big strategies, using registered accounts, leveraging business income, and of course, the classic wealth builder, real estate. And to wrap it all up, we'll talk about what it really means to play this financial game to win. The biggest issue for most working Canadians is just how hard it is to get ahead. You work your tail off, you get a raise, but at the end of the day, it feels like you're stuck on this financial treadmill, just running in place. So why is that? Well, it really all boils down to this one question. You see that big, exciting number on your job offer, but then the amount that actually lands in your bank account, it can be a real shock. And the reason is simple. As an employee, the government taxes you on your full gross income before you've even had a chance to pay your own bills. Just look at this. Say you earn a salary of $100,000. Well, after the government takes its cut, you might only see about $70,000 of that in your pocket. That's $30,000 just gone before you can spend or invest a single dollar of it. This is the tax trap we have to figure out how to solve. Okay, so let's jump into our first strategy. For most employees, this is one of the only major ways to fight back and seriously lower that tax bill. Think of it as your power tool. And to understand how this works, you have to get this one key term, taxable income. See, this isn't your total salary. It's the specific amount of your income the government is legally allowed to touch. The whole game is about making this number as small as legally possible. And here's exactly how you do it. We start with that $100,000 income. Now let's say you contribute to your RRSP and the new first home savings account. By putting in a combined $26,000, you get to instantly subtract that from your income. Just like that, your taxable income plummets from $100,000 down to just $74,000. So what does that actually mean in real dollars? It means saving around $8,000 in taxes every single year. We're not talking a few $100 here. That's a family vacation, a huge boost to your investments, or a big chunk of debt paid off. This is money that makes a real, tangible difference. But wait, the immediate tax savings? That's only half the story. The other major benefit is that the money inside these special accounts grows without getting constantly chipped away by taxes. Your RSSP is tax-deferred, and your TFSA and FHSA, your investments in there can grow completely 100% tax-free. To see just how powerful this is, let's look at the long game. Imagine you invest $10,000 a year for 30 years in just a regular, old investment account. Since you're paying tax on the growth along the way, you'd end up with about $790,000, which, is not bad. But check this out. The exact same investment, with the exact same returns, but inside a tax-free account like a TFSA, it grows to over $1.1 million. The only thing that changed was the type of account you used. No extra taxes paid on that growth. That is a $340,000 difference. I mean, let that sink in for a second. This isn't about being a stock-picking genius. It's just about knowing the rules and choosing the right account to play in. All right, our second strategy is a really big one. It's a fundamental shift in how you think about earning money. It's all about moving from employment income to business income. And the difference is so simple, but it is absolutely profound. As we saw, an employee gets taxed on their full income right off the top. But a business owner, they get taxed on their profit. That's the income that's left after they've paid for all their legitimate business expenses. This is the magic of the write-off. Let's look at an example with a bigger income. Imagine an employee and a business owner, and they both bring in $200,000. And let's say they both have $30,000 in work-related expenses. Well, look at that taxable income line. The employee is taxed on the full $200,000, but the business owner, they're only taxed on the $170,000 profit. And what does that mean for their wallet? It's a $12,000 difference in taxes paid every year. Seriously, what could you do with an extra $12,000? And this advantage just gets bigger and bigger as your income grows and you move into higher tax brackets. But if you really want to level up, you can incorporate your business. This unlocks even more power. First, the corporation itself pays a way lower tax rate on its profits. But here's the real game changer. You, the owner, get to decide how much salary to pay yourself. This gives you incredible control over your personal taxable income. Okay, let's move on to our third and final strategy. This is one of the most classic, time-tested ways to build serious wealth in Canada: real estate. Now, this entire strategy really hinges on one of the most powerful tax rules in the entire Canadian system. It's called the principal residence exemption. And what it means in simple terms is that when you sell the home that you actually live in, any profit you make on that sale is completely tax-free. Yep, zero, zilch, nada. If you buy a home for $500,000 and sell it years later for $1 million, that $500,000 gain is all yours. No tax bill. This is hands down how many Canadians have become millionaires. But hey, your own home is really just the beginning. Owning rental properties can build wealth in multiple ways at once. First, you've got price appreciation as the property's value grows. Second, you can generate positive cash flow every month from the rent. And third, your tenants are literally paying down your mortgage for you, building your equity. Plus, just like any other business, you get to write off all the eligible expenses against that rental income. So we've covered the 3 big strategies. But the real takeaway here isn't just a list of tactics. It's about adopting a whole new way of thinking about your finances. And this analogy is just perfect. You can go through your whole life just kind of passively paying whatever tax bill comes your way, just moving your piece around the board when you're told. Or you can take the time to learn the rules of the game. And that is how real wealth is built, not just by working hard, but by working smart. So there you have it. You now have the foundational rules for 3 of the most powerful tax-saving strategies in Canada: choosing the right accounts, changing your income type, and leveraging property. The only question left is, what's your next move?